Hi, Dan Kurz, DK Analytics. Thanks a lot for tuning in. It's October 21st, 2016. We wanted to chime in with a follow-up report to the other day's video on confidence, on investor confidence in our political slash economic slash financial system and trajectory. We're going to argue once again and focus on the quantifiable aspects of this versus the qualitative aspects, that we're heading in the wrong direction in terms of fundamentals. Yet at the same time, assets, mainly stocks and especially bonds, are priced for perfection and beyond, thanks to the machinations of central banks, in plain English, purchases of truckloads of bonds, even corporate bonds, sometimes stocks, to raise those valuations beyond what free market would pay for them, and thus cheat investors out of real rates of return when they invest their savings. And that is not how capitalism works longer term, needless to say. Today, what I think we want to focus on are things such as debt, such as inflation, such as productivity, such as behavior on behalf of depositors, and quantify the negative impact of a actually multi-decade trend in the wrong direction as regards public policy, most especially as regards the rule of law, sanctity of the rule of law, also as an extension of property right protections, that what you have earned after taxes can't just be taken away from you in some kind of fiat agenda based upon people that control the instrumentalities of power that unconstitutionally divorce you from what is yours. That has been happening increasingly, actually throughout the West, some of it dressed as environmentally friendly, others dressed up as saving people in dire straits, when in fact it creates an economic environment that makes us contend with the USSR revisited or Cuba revisited. They do similar stunts, and all in the name of the good of the people, and at the end of the day, it's for the good of the few elite. Are manifestations of the increasingly negative public policy leave skid marks macroeconomically, microeconomically, and also absolutely balance sheet wise across the board from top to bottom, from nation to state to pension funds to individuals and companies. So here is the fallout. At the global level, if we peel back this onion, we start with the globe, we see that since the 07-08 recession and the huge fallout, where central banks came in to provide liquidity and then became solvency providers, what we see is that debt is up about $65 trillion since 07-08. That's the rough equivalent of 1 year's GDP. And this has been enabled through banks that, in essence, are counterfeiting currencies to offset governments not living within their means and not staying on a trajectory that maximizes incentives to employ and to invest. Right? So this is something that isn't just to be taken lightly. We all know that you can't grow debt ahead of output or income forever. So this takes away from future growth. We have also, as a result of this toxic policy stew, globally speaking, where we don't pay homage to sound regulatory, tax, and property right protections, and thus the incentives for people to build better widgets and for small companies to grow and hire people. And those are the things that are in essence holding us back and will hold us back and will make it even harder to grow out of this huge mess that we've gotten ourselves into. That is crony capitalism fiat money and fiat government, right? The hit at the debt or the balance sheet level, if we peel back that onion to the national level and look at it from the governmental perspective, that is the federal government's debt, which is what taxpayers owe each other and to a large degree now the rest of the world, is above 100% of GDP. During the Obama administration so far, since January 09, federal debt is up almost $9 trillion. We have at the same, during the same time period, federal tax receipts that are up from 09 till now by nearly 84%. So clearly it isn't the lack of tax revenues. In fact, these tax revenues have been achieved through increases in taxation, which is a hindrance to capital formation in and of itself, and has a negative shadow that it casts over future productivity and output. And we see that in corporations that are investing less and less, and instead are opting for share buybacks that are made possible thanks to zero interest rate policies. So there are very negative quantifiable aspects to our current toxic public policy stew. And it doesn't just go to global debt, or doesn't just go to local debt, but it also extends to the way that the U.S. government keeps its books, and to a degree other nations as well, which is declining. Let me give you a for instance, and this goes back to credibility. Trust, right? And are things like they appear to be? Are the numbers the truth, or are these back in the USSR kind of economic statistics that we're looking at? Specifically, the federal deficit last year was roughly $600 billion, yet federal debt went up by something like $1.6 trillion. This has been happening again and again. And anyone with any accounting background knows that debt is supposed to go up by the size of the deficit of your operations. You can do it with free cash flow as well. Well, that disconnect is difficult to explain, and is confidence undermining, especially given a large difference and the sustained difference in debt that goes up by substantially more, 2-3 times as much as annual deficits. Staying with government statistics and how burdensome this is on the credibility front, all of us know that inflation in the real world is much higher than 1 or 2%. If anyone is engaged in shopping, if people are engaged in paying rent or perhaps for their children, if people are purchasing health care or health scare, if people are engaged in tuition payments, they see that, in fact, all these services and the majority of their consumption basket is rising 2, 3, 4 times as much as the government CPI, or the inflation rate. This is not only discouraging because it is so misleading, but it also has a very negative impact on real GDP growth. Specifically, if we take nominal GDP growth, we deflate it, reduce it by the inflation rate, and we come up with the weakest economic recession in the post-World War II period, 1 or 2% real GDP growth. However, if we actually had a fair inflation rate and we took nominal GDP growth and reduced it by the real rate of inflation, then we'd have negative real GDP growth, which frankly is consistent with lots of people's experience in the economy, whether it's rapidly declining full-time jobs, whether it is a labor force participation rate that is at nearly 4-decade lows. We just don't have a vibrant economy, and people's real incomes are at levels that are, back into the early 70s. So we have this disconnect. We have this rosy picture pointed by the federal bean counters that is not honest, and they've moved the needle and adjusted things from where they stood in the 70s and 80s to put a nice shine on bad numbers, right? And this is something, this was part of a toxic public policy stew. It's also dishonest, and it extends to, obviously, central bank policies. of punishing savers and rewarding debtors and leading to debt mountains because they're now financeable through savings that are produced through thin air. If we take a look at the global bonds, about $14 trillion worth of global bonds sport negative yields. That is, you as a saver or investor need to pay the entity, be it a government, even corporations, or sometimes banks, money to make your hard-earned cash available. You don't get money, never mind not having a real rate of return or some kind of protection against default, be it the inflation type or the inability to pay type. You actually have to part with part of your capital every year. You're deeding it over. Well, the Germans and the Japanese have been buying record amounts of safes through the 2016 year to take their notes, their yen and their euro notes, the heck out of deposits or bank accounts and put them into safes. This way, at least they don't suffer the indignity of having to pay for the privilege of lending people their money, number one. And number two, they sidestep growing bail-in risks. Talk about a toxic public policy, Stu. The fact is that a number of Western countries, including the UK and the United States, have laws on the books where you are, as a depositor, are become a creditor and a junior creditor. In other words, you're behind the derivatives casino operations of the banks. And Congress has backstopped that as well within the FDIC program. So you are at risk. Your hard-earned money in banks is at risk for being bailed in to support negative derivatives outcomes, which are just huge on the one hand, and you might be turned into an equity holder and bank share on the other to support the casino operations of the bank chieftains in the derivatives arena. So that's not a wholesome, fair, equitable, sound way to run an economy and to treat savers and people that are invested in assets which are juiced thanks to the interventions and machinations of central banks are increasingly in aggregate seeing all of the weak areas, the manifestation of these policies, whether it's very lethargic GDP, whether it's the weakest productivity growth since the 70s in the United States for 6-7 quarters, whether it's massive and growing debt, whether it's income levels that are below where they've been for 4 decades in real terms at the family level. We know that this is not correct, and those assets are going to at some point be revalued sharply down as bond vigilantes or whoever over or trump the central banks. That is the quantifiable aspect of our look at confidence. That is, these are the factors that 1 or 2 or 3 can be the straw that breaks the camel's back and can lead to a flurry of sell orders that will trump by a large margin any efforts of central banks. Remember, they buy globally about $6 trillion. Investable assets globally, mostly bonds and stocks, are about $300 trillion. When investors decide the bank puts are no longer money good, you have to be out of harm's way. And that is our opportunity to then be able to revisit assets where you get lower PEs, where you get decent yields, real yields. And remember, we don't have reversion in economic markets to the mean. We have reversion beyond the mean. We go from overvaluation to undervaluation. And it's undervaluation that will give us the ability to really lock in great returns going forward. But first, we have to sidestep these bubbles. That is our message. This is the quantifiable aspect of it. We hope you find it of use. Thank you for your interest. We hope you look at our reports for more details.